Welcome, and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. Today we're going to be learning about something that many of us know about, but many of us probably don't plan as well as we should. It's known as climbing the retirement mountain. Today we're going to be learning from a financial advisor who likes to educate about the steps of getting through the retirement, as well as learning how to protect our nest egg, what the 4% rule is and why it's outdated, the different types of annuities, and why not draw on your total Social Security early, the need for estate planning sooner rather than later, and using insurance to fund a tax-free retirement. He has dedicated more than a decade of his professional career to helping retirees and pre-retirees attain their financial, retirement, and estate planning goals. He is a partner and co-founder of Strategy Financial Group, headquartered in Phoenix, Arizona, and he assists clients throughout Arizona and the United States. I'd like to welcome to the Beyond 50 radio program today our guest, author of the book Climbing the Retirement Mountain, Calvin Getz. Calvin, thank you for joining us here on the program today.
Hey, thank you for having me, Daniel.
You bet. Now let's talk about how you decided to get into this industry. Was there a particular dedication or motivation that you had that you just weren't seeing out there from maybe other advisors, or confusion with how people were understanding what it meant to plan for their retirement?
Well, something happened very close to home that helped inspire a dedication to retirement income planning, and that was I watched my own father get laid off during the 2008 market downturn. He was in the construction industry. He worked for a large commercial builder in Tucson, Arizona, and he had been there for over 25 years. And over a course of about 6 months, that company went from 40 employees down to 4, and then they went out of business. He was 62 years old, and he found himself without a pension, without a severance, and without a job. And so I watched the struggles that he went through, and I had been in the financial services industry cutting my teeth, but I realized the necessity for having a comprehensive plan, whether it's creating an income plan, investment plan, tax plan, healthcare plan, and estate plan. Those were all areas that he was not getting the kind of service that he needed. So that's helped inform what I do today.
Now, tell us, starting off, first of all, what are some things people aren't aware of about planning for their retirement that they should be when it comes to getting started? Because I know one thing is, we hear about retirement, but when we're young, we just really don't think about it too much. I mean, it's in the back of our minds, but we figure we've got plenty of time. And all of a sudden, the decade goes by, you're in your 30s, you're in your 40s, pretty soon you're in your 50s, and you really start thinking about it, and you realize, oh man, I wish I had taken advantage of the time that I had.
That's exactly right. You're that's the magic word too. Time is your best investment strategy. So if you're listening to this call and you're planning for your own retirement, or you have children that are maybe in their teens or 20s or above, getting them to understand the importance of paying themselves first and trying to put a portion of everything that they make away. One of the general rules of thumb is around 10% of your income. If you can get in the habit at an early age of putting away at least 10% of your income and growing that money tax deferred, that will certainly put you on the right track for having enough money for retirement. But the other things that people don't think about, they don't think about the impacts of inflation. And so when we build a retirement income plan for somebody and we go through their budget and figure out how much do they need to live on per month to maintain their lifestyle, including travel and donations to charities and everything, if somebody gives me a number of, let's say, $5,000 a month, they really haven't quantified the fact that in 10 years, with a 3% cost of living increase, what is that monthly amount going to be then? And what is it going to be? 20 years down the road? So,
go ahead. Continue, please.
No. So the effects of inflation, not having a proper budget, managing expenses properly, paying down debt so that by the time you retire, you're hopefully debt-free, you don't have a mortgage. Those are all some of the critical things that we try to do when building a plan.
So now one of the things I'm hearing from you here is a key area that you should be paying attention to is to see about as you plan for your retirement, as you're looking for investments or ways to do that, is you really want to stay ahead of inflation. But the other thing I would hazard as you write about here in your book, Climbing the Retirement Mountain, is that we also want to be concerned, what is our tax strategy as well, wouldn't it be?
That's right. One of the other important things, especially for higher net worth clients, is to minimize taxation in retirement, and especially on Social Security. Not everybody realizes that when you receive Social Security that it may be subject to ordinary income tax depending on something called provisional income rules. Your provisional income is half your Social Security plus your adjusted gross income. So when you add those two numbers together for a married couple today, if that exceeds $44,000, then they may pay tax on up to 85% of their Social Security benefit. So if we can figure out ways while they're working or before collecting Social Security to work on doing what are called Roth conversions so that we're minimizing the amount of money that is going to be taxable in retirement, we can have income above the $44,000. However, it may not count towards that provisional income calculation so that we can almost eliminate tax on our Social Security benefits.
Now, back in the 1980s, I was going to talk about an interesting story, Calvin, where I was involved with a company that was out there trying to dedicate themselves to helping people understand something called life insurance. Many of us have heard about this. And their philosophy was based on buying term and investing the difference, into things that you can actually go and invest in more freely than you could with inside of an insurance plan. The whole dedication was basically they were saying whole life insurance and universal life insurance, those things are bad, And so over the years I kind of, slightly embraced that philosophy, but then finally I began to read or dedicate myself a little bit anyway to understand more about how money works and the like. And so I began to look into these things, and I realized the genius behind what those things actually did. I mean, one of the things they would espouse is, okay, so you're putting money in there and you're saving money into one of these, what they call whole life or universal life policies. And for you to take money out, they suggest anyway that you borrow your money. And I'll never forget the guy who was talking with me, and he was training me and saying, why would you need to borrow your own money? But then it was explained why you do that. And that is because when you borrow the money, you don't pay taxes on it. It's not considered, I guess, a capital gain. And then you pay yourself back, and that seemed to be a bad thing as well. And you pay yourself back, and I thought, wait a minute, think about this. Can you imagine if you're your own bank, and then you turn around and you borrow money, so you're not paying taxes on it, and then you pay yourself back? That's kind of a neat deal, don't you think? So why don't we talk about what indexed universal life is, how it works?
Well, that's a good question. As I matured in this industry as well, one of the aha moments that I had years ago was working with a coach and mentor of mine named Ed Slott. And Ed Slott is a CPA, and he trains different CPAs and advisors on how to help your clients in retirement minimize taxes. And through his programs, which are also on PBS, one of the main discoveries and the aha moments was that the exemption for life insurance in the tax code is the biggest exemption that's out there. It's the biggest loophole that's out there. It's one of the only ways, and for an index universal life policy, it's one of the only places where higher income earners are not limited on the contribution amount that they want to put in every year, like you are on a traditional 401k or IRA plan. A 401k plan, you can put in up to $18,000 a year, and if you're over 50, there's an extra $6,000 catch-up, so a total of $24,000. In an index universal life policy, I have a surgeon at the Mayo Clinic as a client, and he wants to put away $50,000 to $75,000 a year for retirement. So where is a vehicle where he can put that amount of money away per year? The money will grow tax-free within the policy, and when he takes the money back out, it will also be tax-free. And so that vehicle exists on the chassis of what's called an index universal life policy. Now, there's a lot of different companies that offer them, so it's a matter of shopping the marketplace at the time you're going to do it to make sure you're getting the best option that's out there. But in general, an index universal life policy allows you to link your growth to the S&P 500. You'll have a floor of 0 if there's a down year, so that we can't lose value due to market declines. And you'll have a cap somewhere in the 12 to 14% range. And the gains will be locked in on an annual reset type method. So if you set up the account on May 1st, then from May 1st to May 1st every year, you get the first 12% of whatever the S&P 500 does, and you lock in the gains to the principal, and you can't lose value during a down year if the stock market goes down. Now, you do have costs of insurance that are built into those policies, so that's important to know. Sometimes there's a surrender charge associated as well. So these are really designed for people who are planning to save money over time and generate additional tax-free income for themselves in the future. But what ends up happening a lot of times for higher net worth clients is that sometimes the money that they end up saving for retirement, they don't end up needing all of it. So if they don't use or borrow back money out of the policy and use everything for their own benefit, then whatever's left pays tax-free to the spouse or to the kids. So this can be a tool for people, especially if they've ended up saving a lot of money in their traditional IRAs, and they realize once they hit mid-60s or 70s that they're not going to probably need this money for their own retirement. Maybe they have pensions or other sources of income, and they're not going to touch it. They can actually start converting chunks of their IRA over a period of years to an index universal life policy. If they need the money back out, they'll have access to it tax-free. And if they don't need it, they'll leave even more money to their heirs, and the benefit will be tax-free rather than taxable if it was coming from a traditional IRA.
And the other thing, too, I wanted to point out is that, as you look at life insurance, especially indexed universal life insurance, or whole life, if you will, is that there's also a death benefit. So basically, you can set this up, as I understand it, that there's a particular goal you might have in mind. And let's just pretend, for the sake of the conversation here, I'd like to have $1 million by the time I retire. So you take out a death benefit of $1 million, and then that is your goal. But if you don't happen to reach that goal, well, think about the difference between what you've actually put in and what that death benefit is, should an untimely death occur. And you kind of think, well, an IRA is not going to do that for you.
That's right. Well, and many times when we structure these policies for the right situation, we'll have what's called an increasing face amount or increasing death benefit. And the reason we do that is we want a lower death benefit in earlier years, and as more money is paid into the policy, then the death benefit will slowly increase over time. And the purpose of that is that the cost of insurance charge inside the policy is based on the death benefit and the client age. So we don't want a high-level death benefit right up front unless we're designing it for strictly for a death benefit purpose. If we're designing a policy that's going to be for accumulation and potentially income during your lifetime, we're going to ramp up the death benefit and grow it over time so that the policy charges are low in the beginning and they only grow as there's actual money in the policy to support it.
Now, that sounds to me like it would also be something that's good for people who are a little bit later on in life deciding to plan for their retirement. Would that be a good way to look at it?
Yeah, it can be a good way to look at it. Many times I'm using this for people who are making good income and the current available options of 401k plans or IRAs don't allow them to put away as much money as they actually would like to. And so it's really, for example, I do this for myself, and I put away a few $1,000s a month into an index universal life policy, and I've been doing it for almost a decade now. And it's just
sounds like you're going to be living pretty large here pretty soon, huh?
Well, but the goal is I understand how the tax rules work, and I want to make sure that I'm putting some of my money away in a place where I can avoid stock market risk. I can have a guarantee of what that plan is going to provide in the future as far as a minimum that I can't lose value. And I understand the rules on how it's going to grow and how I'm going to access the money back out tax-free. So it's in my mind, it's kind of like a mega version of a Roth IRA.
Now, I know one thing that I think many of us fall into the trap of course, is thinking in a positive way about what we look like or what our experiences will be later on in life in retirement years. We tend to believe that, well, when we retire, we're going to be pretty healthy, things are going to be okay. But that is one of the biggest areas that you should really be thinking about, especially earlier in your years, about the possibility that perhaps there may be a health problem or a challenge. And now, you talk about a variety of long-term care insurances that are available. First of all, talk about why long-term care is important. And then you also share about alternatives and hybrids that link to a life insurance policy, such as what we're discussing right here. Tell us about that.
Well, traditional long-term care insurance that marketplace has become more and more difficult to access for consumers and more difficult for insurers to price properly. The inflation effects in the healthcare industry have really made it difficult for insurance companies to calculate how much they should really charge for those long-term care policies. So lately I've found myself not offering traditional long-term care as frequently and looking for something that's a life insurance policy but offers accelerated death benefit options for critical or chronic illness. What that means is, let me give you an example. I had some clients the other day, Tom and Joanne. They're both 70 and a half. They have to start taking out minimum withdrawals from their IRA. They don't need the money, and if the IRS rule wasn't that they had to take it, they wouldn't be taking it. So now that they have to draw out these required minimum withdrawals and they end up with several $1,000s a year after taxes, they can either spend that money, which they don't need it, they can put it at the bank, and save it. They could put it in, buy stocks or mutual funds and invest it and risk it. Or they can use that required minimum withdrawal to fund a life insurance policy. That death benefit on that policy, and in this example, they both ended up buying a $250,000 death benefit, that policy includes an accelerated benefit feature. So if either of them get sick or they can't do 2 out of 6 activities of daily living, which is the technical definition of being incapacitated, they can start accelerating the death benefit tax-free during their lifetime so that they can help fund any care needs that they have with that death benefit tax-free. And anything that they don't use, if they died after 1 year, for example, and they only used maybe $100,000 of the $250,000, the balance would still pay to the surviving spouse as a tax-free benefit. So it's a creative way that insurance companies have come up with because they're finding it very difficult to price traditional long-term care insurance. And think about it. If you buy a traditional long-term care policy and then you live a long time and die in your sleep, that policy isn't going to pay out anything to the surviving spouse, and you're not going to get any of your money back. So if you buy a life insurance policy that you can accelerate if you get sick, and if you don't need it, it pays to your family anyway, then it's a win-win because you know what you're paying is going to provide some benefit regardless of how you use it.
Now, just to be clear for our listeners here, what does it mean by accelerated death benefit?
Many companies will allow you to accelerate up to 2% of the death benefit amount. So on these policies for Tom and Joanne, they were $250,000 each. So they're able to accelerate $5,000 per month for long-term care needs should they need it. And the other thing you want to look for is you want to make sure that it doesn't require actual confinement for the accelerated benefits to kick in because most people want to be able to stay at home and maintain their independence as long as possible. And if they had $5,000 a month of tax-free income coming in from their policy for up to 50 months, that could really help support nursing care or support within the home so that they can maintain their independence as long as possible.
Now, it's when we hear about on television, you read in the paper, perhaps in magazines, we always hear about IRAs and 401ks when it comes to retirement. But something you don't hear as much, and something you write dedicate a full chapter to in your book, is that of a thing known as an annuity. What is this? I mean, it seems that you talk about how you can weather an economic storm with an annuity, but what exactly is it? How does it work?
Sure. Well, there's a variety of different types of annuities. An annuity is a tax-deferred retirement account through an insurance company. So when you're placing your money somewhere and saving it for retirement, you can put money at the bank, and you can buy bank deposits or CDs or savings accounts. You can put your money at a brokerage firm and buy stocks, bonds, mutual funds, etc. Or you can put your money at an insurance company, and whether you're buying life insurance or a type of annuity. The three main types of annuities that are out there, first is called a fixed annuity, a traditional fixed annuity. And that is similar to how a CD, a fixed annuity might pay, for example, 3% per year for 3 years. The next type of annuity is called a variable annuity. A variable annuity is a security. It's where the insurance company invests in mutual funds. There are different riders that you can add to those contracts. I'm not a big fan of variable annuities for retirement planning because of the fees that are involved and the risk that's associated with ownership. Unfortunately, the majority of annuity sales out there, or the majority of annuity owners out there, have a variable annuity product. The third type of annuity is a hybrid of the two. It's a type of fixed annuity, but it's called a fixed indexed annuity. And a fixed indexed annuity will provide safety of principal, like a traditional fixed annuity, and it'll give some upside growth potential linked to a market index so that you can try to earn more interest than a regular fixed product. Now, these are not designed to compete with the stock market. They're simply designed to be the highest interest earning potential options available in the safe money world, competing with CDs and other fixed annuities. What I do like about some of these products is that you can customize them for the client need. So if the client has an income need starting in 5 years, for example, I did a case yesterday where the income plan showed that we were going to have a $3,000 monthly deficit once the client retired 5 years from now. So the client had saved $500,000 towards retirement so far. We were able to piece off about $230,000 and purchase a fixed indexed annuity with a lifetime income rider that would defer and grow at a guaranteed rate and then trigger $3,000 a month for life starting in 5 years. That fills the gap and gives them a guarantee of lifetime income so that with their Social Security, they can maintain their standard of living regardless of what happens with the stock market and the rest of their money.
Now, we talked earlier about two things that we need to be aware of when it comes to retirement planning. The first is being able to stay, of course, ahead of the inflation curve. Second thing is maximizing or reducing tax liability. And, and I guess the third thing would be to pay attention to fees when it comes to investing your money or looking for someone to help you to do that. Let's describe what the difference between a financial advisor is and what a broker is.
Sure. Most people are not familiar with the difference in licensing for people in the financial services industry. Most people who get financial advice get it from somebody on the brokerage side. That doesn't mean it's bad. It just means they're held to what's called a suitability standard. They're allowed to disclose any conflicts of interest. And many of the products that are sold on the security side will pay an upfront commission that comes out of the client deposit immediately when it's purchased. On the investment advisor side, you have folks who are fee-only fiduciaries. So if you're a fiduciary on behalf of the client, that means that you're legally obligated to place the client's best interest first. So if you're purchasing securities products from somebody who's a fiduciary, those products are usually going to have a charge on the overall size of the portfolio that's paid over time, which means that you and the advisor are on the same side of the table trying to choose investments that are going to grow for the client over time because you're paid based on the size of the portfolio. Let me give you an example. Many brokerage firms sell what are called Class A shares or Class A mutual funds. I worked with my brother-in-law in Tucson years ago, and when I reviewed his portfolio, we found that almost every single holding in his portfolio was a 5.75% front-end load Class A mutual fund. So if you took $1 million portfolio, 5.75% on that is $57,500 that came right off the top when those mutual funds were sold.
Just right off the bat, wow.
That's
right
a lot
of money.
Off the bat. So if you were working with somebody who was a fee-only fiduciary, and let's say they were charging you 1% as an investment advisor, it would take them 5+ years to make the same amount of money as that broker made day one when they sold the mutual funds. So it's important to know the difference in licensing. Now, there's some changes that are happening right now. The Department of Labor has issued a rule called the Fiduciary Standard, which would make all financial advice givers, including brokers, adhere to the fiduciary standard that investment advisors are already under. That rule was set to take effect April of 2017, right now. However, there's recently been a 60-day hold put on that rule, and it remains to be seen if any final last-minute adjustments will be made to the rule itself or the enforcement of that rule going forward.
Now, because our show is called Beyond 50, what if somebody comes into your office, maybe they have a limited income or some income coming, and they decide, I've never really done anything before, but I want to get started now. What direction would you typically go? I'm sure that it varies depending on their income and their ability to have that spendable income to invest in, but what would you suggest to them?
Well, the first thing that I do is take each of my new prospective clients through a 3-step process. It's called my Retirement Roadmap 3-Step Review. Step 1, I have them bring in all of their statements, tax return, and estate planning documents, and we review that tax return and see if there's any way that we can find money that's falling through the cracks. Step 2 is to help them draft a retirement income plan, where we talk about the best claiming strategies for Social Security, pensions, and whether or not we're going to have a gap in their needed retirement income in the future, and the best ways to solve for that gap. And then the third part of that process is doing a comprehensive risk and fee analysis, so we can try to strip out as many costs in the portfolio as possible and make sure that any risk assets or portfolio assets that somebody has are allocated appropriately based on their comfort level. During 2008, from the highest point that the market was at to the lowest point was about a 57% swing. And so you have to make sure that if people have money invested in a portfolio, that they're comfortable with that kind of volatility. And that was the S&P 500, the top 500 companies in the U.S. that had that swing. Many times people who are approaching retirement want a little bit less volatility built into that portfolio. And so taking them through that process helps educate them so that they can make the right decisions with their retirement dollars.
Now, one thing you wrote about that people should be aware of, too, and just not too long ago, we actually had an income tax strategist who actually is out there dedicated to helping people understand how the IRS works and what you do when you're in the process, for instance, of being, having maybe your account seized, whatever the case is, the processes when you start receiving these letters in the mail, to be able to work with the IRS and keep yourself from getting into trouble in the first place. And, one of the things that should be considered about that is the idea of what is known as phantom income. And I found it very, very eye-opening when he was sharing some of the things that the IRS could actually consider to be income. For instance, let's just say that your grandfather decides, you are my favorite grandson, so I'm going to go ahead and I'm going to give you, let's say, a really nice fishing boat. Then all of a sudden the IRS decides to come in for whatever reason and they decide to audit you. They're looking at your income, and then all of a sudden this auditor looks outside the house and sees this boat and says, well, you didn't claim that on your income statement. They actually consider that income. You talk about phantom income. What exactly is that?
Sure. Phantom income affects millions of Americans every year at tax time. So let me give you a quick example. Let's say you had $500,000 of after-tax money, so money that's not in a retirement plan, and you invested in mutual funds. Over the course of the year, that investment manager, whoever's actually pulling the trigger on the holdings inside that mutual fund, they're buying and selling and trading. What happens, though, is that if you have a year, for example, where there's, let's say, a decline like 2008, and your $500,000 is only worth $300,000 at the end of the year, you never sold any of the mutual funds, but the trading that took place during that year, if there were any trades inside that fund that had a positive gain, those gains get passed on to you. And so when you check the mail in January, you may have a 1099 and you owe $10,000 based on the positive gains on some of those trades, even if the net result of all of the trading was a loss at the end of the year, even if you didn't sell the mutual fund. So CNN Money did a study a few years ago and found that over $24 billion was collected in that type of taxation just a few years ago.
Really?
So
that's a lot of money.
It's a lot of money, and it's a little bit of money out of a lot of people's pocket. So if you're listening to this show right now and you have non-qualified money or after-tax money that's invested in mutual funds, then you want to look on page 1 of your return, of your tax return, and most likely you're going to see where that's hitting page 1 of the return. If you don't need that income for your current monthly needs, you may look at ways of trying to grow that income tax deferred so that you can avoid the phantom income problem.
Now, I just want to be clear as we slightly go back to, let's say, the indexed universal life insurance policies that we were talking about earlier. So this money that you're talking about now, with this, that you have, let's say, this $500,000, wouldn't you be able to put that, because I think in these life insurance policies, and certainly I'm not totally sure if this is true, you can kind of bulk that into there and kind of keep it safe, couldn't you? As far as putting it into the policies, that is.
Well, you can put non-qualified money and use that to fund a policy like that if you choose. It depends on if it's the right situation or not. You can also put some of that money into different types of annuities to grow tax deferred as well.
So those are possible ways that you would be able to avoid a tax penalty, correct?
Correct. Well,
okay.
It's not a penalty per se, but avoid paying tax on gains.
Okay, yeah, that's kind of the direction I was going there. Another thing you talk about that you dedicate a chapter to in your book, Climbing the Retirement Mountain, is that of a thing known as the 4% rule. This seemed to be something that we bought into until around the 1990s. Tell us why that doesn't work anymore, what exactly it is. Well,
the 4% rule is kind of a generic financial planning rule that says if you only take out about 4% out of your portfolio per year, and you've got, let's say, a 60% stock, 40% bond allocation in your portfolio, that's about the right withdrawal rate, that money should last for as long as you live. Unfortunately, over the last 17 years, we've had 2 major stock market downturns. We had the dot-com crash from 2000 to 2002. Then we had the housing crash, which was primarily during 2008. And what happened is that had you been following that 4% rule, drawdown rule, during that time period, because those drawdowns were so significant in the stock market, and you're taking money out at the same time that the portfolio is going down due to market losses, that drastically affected the ability for a portfolio to last for as many years as somebody may need during retirement. So another thing that comes into play with that is something called sequence of return risk, meaning if you retired in 2007 and started drawing out $3,000 a month from your portfolio right as 2008 was happening, it may be very difficult for you to just stop taking the income because the stock market is going down. Most people have to continue making that withdrawal during that time. So if you retire and there's a major market downturn within the first 5 years or so of retirement, that can drastically affect how many years that portfolio is going to last for. So the old 4% rule is unfortunately kind of out the window. It's really a matter of monitoring it on an annual basis and having other places where you can draw income from during periods of market decline so that you may not have to touch the risk assets and let them recover.
Now, speaking of which, when you talk about paying attention to, as you said, reviewing annually, there's one area that I think people really need to be aware of, and we've certainly talked about this on our program, especially when it comes to retirement and trust planning, is many times people may overlook what it means to take a look, okay, they've got their retirement planning in place and they're going along and things are working well, but then also they want a strategy which may protect their heirs. It could be a spouse, children, or grandchildren. But then they may overlook the fact that, well, you need to kind of update this, kind of maybe take a look at that and see, how you can keep it current. And this could really be a challenge when it comes to retirement planning and the end outcome. Let's talk about what a living trust is and the assumptions that people seem to think about what it will and won't do.
Sure. There are three basic ways that people plan their estate. They can do nothing, which is the most popular estate planning selection being made by most people. You can set up a last will and testament, which may be sufficient in certain circumstances. A will is really there and designed to pass personal property or non-titled assets. But if you're using a will and you own a home and have bank accounts and investments and life insurance, then you want to be really careful because each state may have a limit on how much wealth you can pass with that will without going through a court process called probate when you die. And so that's why a lot of people who have assets choose to set up what's called a revocable living trust. And you'll hear it called a living revocable trust or a revocable trust, all terms to mean essentially the same thing. A revocable living trust is an entity that's created that becomes the new title holder or owner of one's assets, meaning in my trust, I've transferred the deed for my home out of my name personally into the name of the Calvin Getz Trust. And the reason I did that is that if the trust is the owner of the property, I'm the trustee or manager of the trust, but if I become sick or incapacitated or pass away, I've already designated my successor trustee, like an executor role. I've decided who's going to step in and manage those assets that are in the trust in the event of my own disability or incapacity or death. And so it allows me to maintain control of those assets at all times. Plus, because the trust is the owner of the property, if I die, that home does not have to go through probate because it has a legal owner at all times. And that's why having a trust that's funded properly will bypass the court or probate process because the assets will have legal ownership at all times. Where if I had left that deed to the home in just my name, upon my death, that home would be stuck in a deceased person's name, and there would be no legal owner. And even if I had a will is not a legal way for me to bypass the probate process because the asset was stuck without a legal owner at death.
Now, you bring up something that I think our listeners might scratch their head and maybe leave a little confusion with, and I'm sure that you'll be able to clarify this as you've already done, but we see a lot of fiction out there and a lot of truth when it comes to, like as you said, you become incapacitated, so therefore you've appointed somebody who's going to be an executor, if you will, to decide how this is going to be allocated should you not be able to make those kinds of decisions anymore. And I would give a quick example of this. Anna Nicole Smith. It's the best thing that comes to the top of my mind here, okay? So here was somebody who was married to this very wealthy gentleman who died, and he pretty much left everything to her. All of a sudden, the kids come with pitchforks and knives and you name it, saying, wait a minute, this is nonsense. Why would he do that? And they decided to challenge this. And that's one of the things you tend to hear out there, that you have made this decision, okay? Like, for instance, in your case. You've decided to also set up this trust in such a way that there is somebody who decides how you want these things taken care of or distributed, if you will, should you not be able to make those decisions. Then all of a sudden the story goes, well, they went into court and they fought the fact that, well, this guy just wasn't in a mental state of mind to be able to make clear decisions. It sounds to me like once you've put this in action, the courts can't overturn it. Is that how that works?
Well, each case is unique,
Obviously.
But I will say that when somebody spends the time and the money to set up a revocable living trust, because it certainly does take more time than just jotting a few notes down on a piece of paper and trying to make a basic will, the court looks upon that much more in a much stronger sense, because it shows the intent and the time to create a plan. Anybody can contest whatever they want, but whether or not that contestment is going to move forward or hold any weight in a court of law is the difference. And so the more planning that's done, the more time that's spent creating a solid financial plan or a revocable trust plan, for example, I think that's going to be very difficult to challenge in court. In her case, though, you had some unique circumstances. She was much younger, he was much older and ailing in health. And so, I'm always very careful when I have elderly clients who want to make an amendment or a change, especially if there's a family member that's coming in and, driving them to the appointment. You want to make sure that that person is not being coerced or pressured to change things against their will.
Very good. Yeah, that's why I thought that was a very important element to bring up, because about good intentions, it seems people followed, the steps they need to be sure that it goes in that direction. And then once it's set, all of a sudden, there's these challenges that come out of nowhere from people who weren't even in this person's life in the first place. And I just was kind of curious about that.
Yeah, many times there can be contestment clauses or non-contestment clauses in certain documents that will clearly say if any beneficiary or heir at law shall contest the wishes as laid out in my will or trust. For example, if you only left one of your children out of 3, you left them 10% instead of a third because maybe they had some issues or for whatever reason, and they chose to contest your wishes at death. Those types of clauses can say, not only have I intentionally set this up this way, but if anybody contests my wishes, then their share would go from that 10% to 0 by contesting this.
Wow. Hey, there's a way to keep them out of the ring, right?
That's right.
Now, people have followed your example, and there they are, and it's time to retire. Now, the IRS obviously is very creative about how they can find ways to get money. And there was something you talk about known as the senior-only tax. And to me, I say only the Internal Revenue Service could come up with something like this. What is that exactly?
Well, I think are you referencing the required minimum distributions?
Okay.
And so, what happens in retirement is that there's a variety of different taxes that affect people that they're not always prepared for and that nobody's really gone through with them until they reach that point. One of them is that when you hit age 70 and a half, you must start taking out a minimum distribution out of your IRAs. So most people have retired by that point. They've rolled over any 401k plans to an IRA. and they have to start taking out a small amount every year and claiming it as income and paying taxes on it. That can compound in effect on a couple things. We mentioned Social Security may be taxed as ordinary income depending on how much provisional income you have, if it's over $44,000 a year. Well, if you've got $1 million IRA by the time you're 70, just the minimum distribution alone is close to the amount enough to cause you to have to pay taxes on up to 85% of your Social Security. So it's a compound effect. You're taking it out from the IRA, you're claiming it as income, then because it counts as part of your adjusted gross income, then your Social Security may be taxed at a higher level as well.
Now, Social Security, there's the one that seems to have a lot of talk when it comes to people who are wondering whether or not it's going to be available, whether the funds will be available by the time they get to retirement age. And for many people, that seems to be the only thing that's going to be available for them as far as income. Let's talk about Social Security in and of itself and what people should be really aware of versus what they hear or read about out there.
Sure. I think on my latest Social Security statement, it said something to the effect of, without changes to the current Social Security system, by 2033, I believe, Social Security will take in less money than it pays out, which means that they won't be able to pay 100% of all of the benefits that they have to pay. So they might only be able to pay 85% or 75% at that time. So we still have time to fix that. Currently there's a cap on how much of your income has the Social Security tax or FICA tax applied to. So we may see those income caps grow over time. We also have not kept up with the full retirement age being pegged to life expectancy. So as life expectancies have continued to climb and Social Security is paying out more and more checks than it was ever designed originally to do, because life expectancy back when Social Security was originally created, if you went on claim at 62, life expectancy on average was around 66. And so the number of checks that Social Security was planning on paying were fairly limited. Now you have life expectancies for women approaching 85 and for men about 83. And that's just the 50% mark. That means you have 50% of beneficiaries or recipients of Social Security living beyond those age points. So we're paying out for a much longer time period, but yet the full retirement age limit, if you're born after 1960, is 67, and that's never moved any further, even though we're living longer. So I think you're going to see some, and you should want to see some changes to the system made so that we can make it solvent for beneficiaries for as long as they live.
You've certainly outlined a lot of things that our listeners can take in, absorb, and make better decisions, or at least ask better questions. As I would like to advise to our listeners out there, Climbing the Retirement Mountain is certainly a book that you should pick up. It's not a large book, but it's certainly packed with a lot of great, valuable, insightful information. And so as they are here today listening to this, when it comes to taking that next step, you've armed yourself with some good information. What would you say they should do when it comes to finding someone to take those next necessary steps?
Well, I would look for somebody in your area that you can meet with who is a fiduciary. Ask that question. And also look at the disclaimers that people use on their documents. So you want to look at the disclaimer and read, who do they work for? Who are they giving it financial advice on behalf of? You really, in my opinion, should seek out somebody who's fully independent, who can offer any financial products, whether it's on the security side or insurance side, and somebody who's a fiduciary on behalf of the client, and somebody who has experience working in the retirement planning market and who's going to help you design a full comprehensive retirement income plan. If you have questions on what questions to ask your advisor, you can certainly reach out to me or contact me through my website, at www.calvingetz.com.
Very good. Calvin, I want to thank you so much today for joining us and sharing this detailed information with our listeners out there. Again, having good information out there helps you ask better questions. And when you're asking better questions, you certainly will move in the direction of better results. Climbing the retirement mountain is a very good best step. I want to thank you for being here on our program today to share this with our listeners.
Thank you for having me.
You bet. We want to thank you, the listeners out there, for tuning in. Another step you can take is move in the direction of finding us on beyond50radio.com. That is the number 50. We encourage you to sign up for a weekly e-newsletter to stay up to date with what's going on in the world of Beyond 50 as well as upcoming programs. I'm Daniel Davis. Thank you for tuning in. You've been listening to the Beyond 50 radio program, and remember, live your day past halfway.